Hello everyone, my name is Moji. You're watching a Bitcoin bubble news channel. Inflation was also in the double digits in the early 1980s, when Fed Chairman Volcker was trying to kill inflation with interest rates in the double digits. That was a lot of room for him to make a mistake if he did make one. The rate of inflation here is a lot lower now. In fact, the Fed has less room for mistake now. I also think that keeping prices higher for longer and thinking that inflation was the biggest risk has put us in some danger. In 2022, the Federal Reserve started raising interest rates at a speed that had never been seen before. A lot of well-known investors, financial experts, and hedge fund managers raised the alarm. They said that the aggressive actions of the central bank could destroy the world economy and cause chaos and disorder. Even with these warnings, the Fed not only kept raising interest rates quickly to stop inflation, but it also made it clear that it planned to keep rates high for a long time by sending constantly hawkish messages to the markets to stay in charge. Americans are now feeling the full effects of the Fed's policies, just like Fed Chair Jerome Powell warned in his 2022 Jackson Hole speech, where he often talked about former Fed Chair Paul Volcker. It's not just the US. That's feeling the pain other big economies are too, such as the Japanese yen hit a 38-year low against the US dollar last month. For investors, the higher interest rates in the US have made them want to sell the yen and buy US Treasuries, which offer better returns than Japanese government bonds because Japanese interest rates are so low right now. As a result, buyers continue to sell the yen as it falls in value, even though the Bank of Japan has recently tried to stop this from happening. The Japanese stock market is still very unstable, going from record lows to big daily gains. At the same time, American shoppers are also feeling the pinch. Reports say that inflation is slowing down and wages are going up, but prices are still very high. Cathie, founder, CEO, and CIO of ARK Invest, talks about these changes on her most recent show. In the Know, she is worried that the US and global economies may be about to enter a deflationary decade, which means prices will drop and growth will slow down. Additionally, I believe that the idea that the carry trade, which includes the yen, is ending will be talked about more and more in the news. When people talk about the carry trade, they mean that a lot of buyers borrowed yen. In other words, they were short yen. Japan had very low interest rates compared to the rest of the world. So they borrowed yen. By borrowing money there, they then put those assets to work in other currencies or dollar-based assets, but mostly dollar-based assets like our government bonds, which were yielding more. Now, the yen has been either going down or staying the same since 2011, so it was pretty safe to bet that you would short or borrow yen. There wasn't much risk on your part, and if the value of the yen went down, you gained because you were making more money in the US. There are some who believe that part of the carry trade came from borrowing yen and then buying the Mag 6 or one of the broad-based US benchmarks like the SP 500 or the Nasdaq 100. Both of these are very highly populated and weighted with the Mag 6. We don't know how long this lasted. That's why we don't know the exact number. It does make sense when you see how quickly the yen is rising in value now that the carry trade is ending. People who thought the yen would keep falling in value are now changing their minds. Either they're selling to cut their losses, or they're getting balance calls and need to. They are forced to sell. The other thing that might be going on is that people are trying to figure out what else might be wrong. We've tried to figure out, okay, where is the most upside, and there was no doubt that trade and carry was leveraged. That is, in fact, one source of power. Private equity is another one. This is also a good place to learn about business real estate, especially multifamily in the US. Monetary policy, another thing that came up when we talked about Bitcoin in Nashville, is that yes, Bitcoin could be a private currency that takes us back to before the Federal Reserve was created or before 1913. Today, private money is up against public money like the dollar and other paper currencies. There could be a lot of good competition because Bitcoin is a rules-based currency. It basically means that buyers can add more private money to their hedge if they don't like what the Fed or the government is doing. What do we see now in terms of monetary policy? We now have the June fix for M1. The year-over-year change is now 1%, so no longer going down. I believe it was almost 2 years that our money went down every year, or at least 1.5. Let's say that year-over-year money growth was between 0% and 1% in the second quarter. GDP was close to 6% higher than the previous year based on nominal GDP. So the speed is between 5 and 6%. The speed at which money changes hands is called its velocity. Let's say we're right. This moment of relief makes people and companies wait and think, okay, let me see what's going to happen here. I want to check to see if interest rates are going to go down. Another way to say this is that the chance that interest rates will go down has grown a lot. Knowing that interest rates are going to go down is helpful. It's possible that they will drop 50 basis points in September, and then another 25 to 50 basis points in October, November or December, or even both. What are you going to do if you think that way and the media helps you understand that it's possible? You will wait for the rate to be as low as it can be. The same is true for prices. This is deflation, and it's where things start to look a little scary. It's best to wait if you think prices will keep going down. And that slows down the flow of money. Now we're here. This is what really makes a decline happen. Everyone says, wait, let me wait and see what's going to happen here when the flow of money slows down. When rates go down in the past, there was a slump right after. The Fed is taking action. And the National Bureau of Economic Research, NBER, says that when you look back a year or two, you'll usually find that the interest rate was cut in the middle of a slump. At this point, we might be a good way through it by the time history books are written.